The concept of a global financial crisis in 2024 and 2025 is no longer discussed solely in history. Instead, it is a looming risk shaped by contemporary vulnerabilities. High debt, inflationary pressures, and rapid policy shifts are testing markets. Is the world on the brink of renewed financial instability? In this video, we unpack lessons from market turbulence and what investors should watch. During the past 2 years, the world economy has been tested by the aftermath of the pandemic. Persistent inflation and rapid interest rate adjustments have increased stress. Volatile commodity markets and geopolitical risks have amplified vulnerabilities. At the heart is strain from historically high public and private debt. Governments borrowed heavily, and corporations expanded balance sheets during cheap money. As central banks tightened policy to fight inflation, debt servicing costs rose dramatically. That pressure hits sovereign budgets, emerging markets, and leveraged firms. Countries dependent on external borrowing faced capital flight and currency stress. Inflation has eroded purchasing power and strained consumer demand. This combination raises the risk of stagflation when paired with tight credit. Household balance sheets are under strain from higher borrowing costs. Commercial real estate has shown stress as valuations decline with higher rates. Non-bank financial intermediaries have faced liquidity and funding mismatches. Geopolitical conflicts have disrupted supply chains and increased energy volatility. The fragmentation of global trade adds to cost pressures and inflationary tendencies. Climate shocks in 2024 and 2025 have damaged infrastructure and created fiscal burdens. Central banks balanced inflation control with financial stability through 2024 and 2025. Divergent policy paths have created volatility in capital flows for emerging markets. A strong dollar increased debt servicing costs for those with external obligations. Miscalculation by central banks, too tight or too loose, remains a key risk. Rising mortgage and credit costs increase default risks and social strain. In developing economies, high food and fuel costs have sparked unrest in 2024 and 2025. Political instability accelerates capital flight and undermines investor confidence. International institutions emphasize coordinated responses and regulatory vigilance. Strengthening safety nets and debt frameworks is central to resilience. Global debt as a share of world GDP reached record highs and remained elevated into 2024 and 2025. Governments borrowed heavily during the pandemic years, and corporations expanded balance sheets. As policy tightened from 2022 through 2024, the cost of servicing debt rose dramatically. Countries dependent on external borrowing faced difficulty refinancing obligations. Capital flight and currency depreciation increased contagion risk. Inflation eased in some advanced economies but remained destabilizing in 2024 and 2025. Persistent price pressures eroded household purchasing power. Volatile energy and food prices re-emerged due to geopolitical and climate shocks. Financial markets reflected tensions through bouts of volatility and bond yield swings. Several mid-sized banks reported losses tied to commercial real estate exposures. High rates depressed valuations. Remote work reduced office demand. Shadow banking activities faced liquidity squeezes and funding mismatches. Equity markets alternated between rallies and sharp sell-offs. Bond yields adjusted sharply, signaling changing risk premia. These fluctuations reinforce the perception that a crisis could erupt if fragilities align. Geopolitical risks disrupted trade flows and supply chains in 2024 and 2025. Trade restrictions and sanctions increased costs and reduced integration efficiency. Climate-related disasters disrupted agricultural output and raised fiscal burdens. Central banks maintained relatively high policy rates, wary of loosening prematurely. Several emerging market central banks experimented with cuts to support slowing economies. Divergence in policy created volatility in capital flows and dollar funding shortages. A strong dollar exacerbated debt servicing costs for countries with external obligations. Missteps by central banks, holding rates too high or cutting too soon, pose systemic risks. Household borrowing costs rose for mortgages, consumer credit, and small business loans. This increased default risks, where wage growth lagged inflation. Younger households were squeezed by unaffordable rents and higher debt service burdens. In developing economies, food and fuel costs contributed to social unrest in 2024 and 2025. Social tensions amplify financial risks by undermining investor confidence. Policymakers and institutions emphasized coordinated responses and debt restructuring. Efforts to strengthen safety nets aimed to provide buffers against shocks, yet high debt, Persistent inflation, tight credit, and fragile banks leave the system vulnerable. Financial instability often builds gradually and erupts suddenly when confidence falls. As of mid-2025, the global financial system stands at a crossroads. Stability depends on a delicate balance of monetary restraint and fiscal responsibility. Coordination, regulatory foresight, and trust rebuilding are essential for resilience. Whether the coming years bring resilience or crisis will depend on policy adaptation. Past lessons show that hidden fragilities can trigger rapid contagion. Investors should monitor debt loads, bank health, and inflation trajectories carefully. Diversification and liquidity management remain central defensive tools. Regulatory vigilance and stress testing help detect systemic weaknesses early. Monitoring shadow banking and funding liquidity is equally important. Stay alert to geopolitical disruptions that can cascade into market stress. Scenario planning and stress scenarios should be part of investment playbooks. Liquidity buffers and access to dollar funding can be decisive in stress episodes. Coordinated central bank actions and swap lines can calm markets when needed. Stronger regulatory frameworks can reduce the chance of systemic failure. Market participants should prepare for increased volatility and periodic shocks. Transparency, timely information, and confidence matter more than ever. Recovery paths depend on policy calibration and external shocks. Asset allocation should reflect evolving macro and policy risks. Adaptive risk management and contingency planning are crucial. Constant monitoring of economic indicators is key for timely decisions. Market sentiment can flip quickly. Preparedness reduces forced selling. Coordination among fiscal authorities and central banks remains essential. Tools include debt restructuring frameworks and expanded safety nets. Confidence-building measures can prevent sudden withdrawals and contagion. Maintaining adequate capital and liquidity buffers reduces systemic risk. For investors, the focus should be on resilience, not short-term noise. The global system is interconnected. Local shocks can quickly become global. Watch debt dynamics, inflation, bank health, and geopolitical developments closely. Case Study 1. Sovereign stress where high debt and external dependence raised refinancing risks. Timelines show how policy shifts and capital flow reversals can accelerate pressure. Vulnerabilities emerged when external funding tightened and currencies depreciated. Policy responses and debt restructuring options became central to stabilizing markets. Case Study 2. Banking sector stress tied to commercial real estate and funding mismatches. Losses materialized where loan books were concentrated in weak sectors. Higher rates and falling valuations strained bank capital and liquidity. Regulatory interventions and backstops were required to prevent wider contagion. Case Study 3. Shadow banking liquidity squeezes and funding mismatches. Non-bank intermediaries experienced runs when short-term funding dried up. Restoring confidence required clear communication and liquidity support. Coordination across regulators and central banks was often decisive. Across case studies, common themes emerge: leverage, liquidity, and confidence. For investors, practical checks include balance sheet strength and access to funding. Scenario planning and stress testing portfolios are essential steps. Prepare for volatility, preserve liquidity, and stay informed on policy moves. These case studies underscore that localized stress can have global consequences. Timely intervention and clear policy help reduce the probability of broad systemic crises. Investors should watch how policy tools are deployed and communicated. Clarity and decisive action from authorities often prevent confidence collapses. In many cases, preemptive measures can be less costly than reactive ones. Recovery paths vary, but coordination shortens periods of instability. Key takeaways: vigilance, liquidity, policy coordination, and contingency planning. For professional investors, integrating these lessons into strategy is critical. Case studies remind us resilience is built through policy, markets, and prudent investors. Now we connect patterns and analyze implications for portfolios and markets. Analysis. The interplay of debt, inflation, bank fragility, and geopolitics creates nonlinear risks. Small shocks can cascade when confidence is fragile and funding is tight. Policymakers face a tough trade-off between inflation control and financial stability. Coordinated fiscal and monetary responses can mitigate feedback loops. Investors should prioritize liquidity, stress testing, and diversified exposures. Rebalancing to reflect tightening cycles and potential stagflation scenarios is prudent. Use leading indicators and stress scenarios to anticipate turning points. Preserve dry powder for opportunities while protecting against severe drawdowns. Liquidity ladders and cash buffers reduce the need to sell into stress. Diversify across macro regimes and avoid concentration in high-duration assets. Transparent communication from institutions can stabilize expectations and markets. Continued vigilance and adaptability will determine whether resilience prevails. For investors, the goal is not to predict every shock, but to be prepared for multiple outcomes. Monitor debt dynamics, central bank signals, bank health, and geopolitical risk maps daily. Policy clarity, coordination, and investor prudence tilt outcomes toward resilience. The coming years will test the system. Active stewardship matters more than ever. Summary and next steps up ahead. Practical guidance and the subscription prompt follows. In summary, high debt, inflation persistence, tight credit, and geopolitical shocks create credible risk. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.